Hi, my name is Paulinello and I'm a senior accountant here at Beyond Accountancy, and today I'm going to be talking to you about what do I do with my restricted stock units, also known as RSUs. We've been definitely seeing an uptick in our client list receiving this form of compensation from their employer. A common question we get from them is, what do I do with them, and B, what are the tax implications of that? This presentation covers interest received in shares and stapled securities and does not cover interest received in rights. There's a little bit of differences between them. If you did receive interest received in rights, get in contact with our office and we'll be happy to go through that with you. A restricted stock unit is an award of stock shares usually given as a form of employee compensation. The recipient must meet certain conditions before the restricted stock units are transferred to the employee. So these are commonly found in USA companies. Generally in Australia, the remuneration and bonus component is paid in the form of a salary and wage, whereas in the USA, there's usually a higher bonus component and many companies pay bonuses in shares. This is common, we've found in the tech industry. We've got a whole range of clients ranging from Block, Square, and Atlassian, just to name a few, that issue these RSUs to their employees. So restricted stock units are issued to employees through a vesting plan, and the employee is restricted access to them until they achieve required performance milestones or upon remaining with their employer for a particular length of time. Once the RSUs are vested, the employee can then choose to sell them like they normally would with any stock they buy on the ASX. So RSUs are captured under the employee share scheme provisions in Australian tax law. They'll be classified as a tax deferred scheme, and the employee is assessed and taxed on their RSUs when the deferred taxing point occurs. So that is when there will be no real risk of forfeiture and the scheme no longer generally restricts disposal of the share. So you can freely sell and do as you please with the share. So there are three key milestones for an RSU: when the shares are granted, when the shares vest, and that is when the restrictions end, and finally when you sell the shares. We're going to go through the tax implications of each milestone. So the grant of shares has no tax implications in the Australian tax system. So a pretty easy example is if you get granted shares, but a stipulation is you have to be at that company for 3 years and then you get vested the shares. Between the grant date and the vest date, there is absolutely no tax implications at all. The only tax implications if you get a dividend between the grant date and vesting date, which would be taxable. But the grant date itself is not a taxing point. So the vesting point is usually where you're going to pay the most tax. So the ATO charges tax on what they call the difference between the market value of the shares and the amount you as the employee paid for them. RSUs are issued for free, so the discount is 100% of the market value of the shares at the vesting point. Basic example again, if you get granted shares on year 1 worth $50 and they vest in year 3 and the shares now $150, let's say you get granted 1 share, the amount that's included in your taxable income in year 3 is the $150. So technically the vesting date is not always the taxing point. Some large companies have insider trading rules, which means that employees can only buy and sell shares during a trading window. If that happens, the taxing point is the date the window opens. This is because the tax law doesn't say vesting date. It refers to the date when you have no restrictions on selling your shares. So it's going back to those employee share schemes provisions and real risk of forfeiture and no restrictions being on the shares. So the last milestone is the sale of the shares. This will result in a capital gain. So usually the formula for a capital gain event is sale proceeds less cost base, which is essentially how much you sell them for with how much you purchased them for. So the purchase price is going to be the market value at the date the deferred taxing point occurs, as previously explained. And in this example, the share price has gone up, which has resulted into a capital gain. You can use capital losses to offset this gain. So if you've had prior investment, the losses have been carried forward. That can reduce the capital gain event here with the sale of the RSUs. And also the CGT discount can apply if you've held the shares for more than 12 months since the vesting date. That can reduce your capital gain by a further 50%. And in the event that the share price goes down since the vesting point, you can record a capital loss and use that to carry forward, offset against future capital gains. In saying that though, if an employee disposes of their ESN interest within 30 days of the deferred taxing point, the taxing point becomes the time when the employee disposes of the ES interest. If you sell shares within 30 days of the taxing point, you ignore the market value at that date and instead you pay tax on the actual sale proceeds. If you sell within 30 days, you'll ignore capital gains tax as it's irrelevant. So a common basic example is if the market value of the deferred taxing point on day one is $2 and you take 20 days to make a decision and you say, no, I'm going to sell them. What we do is we then grab the market value at that date that you sell them and we include that as the assessable income. But it has to be within 30 days of you receiving the ESS interest for you to forgo the capital gain calculation. So yeah, CGT discount for RSUs, so 50% capital gains discount applies if you hold the shares for over 12 months before you sell them. For RSUs, this is 12 months from the taxing point. And previously in the presentation, you'll notice that the vesting date and the taxing point aren't necessarily the same if you have restrictions on selling the shares since vesting date. So it's always got to be when there is no real risk of forfeiture of the shares and you have no restrictions on the shares. You also need to wait for 1 year and 1 day to get the discount. Another milestone is when you sell them but a capital loss has occurred. This is generally a bad outcome because in this example, the share price had a deferred taxing point of $3, but the price tanked and they were only worth $2.25 when you sold them. So what does this mean for the taxpayers? Let's assume that she received 10,000 RSUs and she's in a 47% tax bracket. The final sale price was 10,000 times the 2.25, which results in her receiving 22,500 in her pocket at the sale date. But the vesting date was different. So that had $3 share price. So she was taxed at 30,000 was included in her assessable income for the year. And she was taxed at 47% because she was in the highest tax bracket. So she's taxed on $14,100. But now when we're recording the capital loss, that can't be used to offset against this assessable income in the financial year because capital losses can only be used to offset against capital gains and not against taxable income. Here's a recap of the vesting milestone. The taxing point is when there are no restrictions on selling the shares. The assessable amount that's included in your tax return is the difference between the market value and the price you paid. So if the market value of the share is $100 and you receive 1 share, that means $100 into your tax return as assessable income. The amount is not a capital gain, so you cannot use capital losses or the 50% CGT discount. So this is just taxed at your marginal tax rates. When do I pay tax on RSU? No tax is deducted from your shares at the time that they vest, unlike you receiving salary and wage and your employer withholds an amount from your paycheck and pays the ATO with it. And then when you lodge your tax return, you've already got an amount withheld. That does not occur in the event of RSUs. You pay tax owing when you lodge your tax return. This could be 18 months after vesting, and we'll go through a bit of a timeline. So let's take a look at an example of when do you pay tax on vested RSUs. In this example, a deferred taxing point has been reached in August 2022. So that's the 2023 financial year. Let's assume that they're on top tax bracket, so they'll owe $23,500 in tax. If you lodge through an accountant, the 2023 financial year, we get an extension to lodge tax returns until 15th of May 2024 would be when we lodge their 2023 tax return, and then you'll get the extended payment date as well if we lodge by that time, which would mean early June 2024 they'd pay this amount to the ATO. So in essence, you really have in that scenario time to plan for this tax bill. We definitely don't want you in a situation where we lodge your tax return and you haven't planned for it and you get hit with this massive tax bill, which may result in you selling your shares, which you didn't want. So here's an example of what you'll receive from your employer. Your employer will have to lodge an employee share scheme statement alignment with the ATO, then subsequently the ATO will have that information. Your employer will then give this statement to you. So you'll see in F that it's discount for deferral scheme. That is the amount that you include in your assessable income in your tax return. So this is the second page of what your employee share statement should be, and it's generally the most helpful one. In here, you'll receive all the shares that are vested within the deferred taxing point of the financial year. Now, you'll find helpful information such as how many shares you received, the deferred taxing point date, which is very vital if you want to receive the CGT 50% discount, for example, the market value at the date, and what is included in your tax return. You'll also notice that here is marked sale, so a little bit different than the other ones that say vesting. That is because it's been sold within the 30-day period, as previously discussed. You can sell them within 30 days of your deferred taxing point. That's all you'll have to do is include the market value at the date you sold them, which would be the sale price, and you can then ignore CGT, any CGT events. The other ones they've just vested, so these are now live for CGT when you sell them. The topic of the presentation, what do I do with my RSUs? Whatever you do, make the decision at the vesting point. The reason for this is you are liable for tax at this point, regardless of whether you sell or not. Your decision is going to be, are you going to sell or are you going to hold? You generally make the decision based on investment criteria, not based on tax considerations. Don't forget, you'll have to pay tax on the vested shares, so put money aside for this. The choice you make depends on your assessment of the future share price performance of your company. So the million-dollar question, where is the stock market going to go tomorrow, next year, 5 years from now? No one has the answers to those questions, probably apart from Warren Buffett. But generally, we have three approaches to what you do with them. First one is the bullish approach. So if you really believe in the company that you work for and you think the share price will keep rising, you want to keep as many shares as possible. You'll still have to pay the tax on them at the vesting date, but you can save up for this throughout the year using your salary. A conservative approach would be to sell some of the shares so you can absolutely have the money to pay the ATO when the time comes. Lastly, if you don't really have a great outlook on the company that you work for, you should just sell all of the shares, keep half for tax if you're on the 47% tax bracket, and invest the rest elsewhere. Interest, other ASX shares, ETFs, pay down the mortgage. If you do have a considerable amount of shares, it's always a great idea to consult a financial planner, as you can tick off your life goals, see what you want financially. One last final point is moving to Australia. What difference does it make if you have these RSUs? A common example we've found with our clients, if they've gained employment in the US and then they've returned to Australia, just a note on the vesting. The vesting date is still a taxing point, but the taxable amount will be lower if they were granted before you arrived. Say if year one, you were granted the shares and you were based in USA, you want to come home, you come to Australia in year two, then they don't vest until year 4. Under that scenario, we'll have to apply a pro rata to the taxable amount to be able to work out the taxable amount. Lastly, selling. If you qualify as a temporary resident under the tax law, capital gains tax won't apply to the subsequent sales. So we deal with some New Zealanders who get some unique benefits as a temporary resident. One of them is not being eligible for capital gains tax while in Australia. All right, guys, that's the end of the presentation. Thank you for watching, and hopefully that was a little introduction to RSUs. Like everything, there is more detail to delve into. You can get in contact with us, make a tax advice appointment if you want to go through any RSUs or tax return preparation as well. We can definitely assist you in that.